Good day, everyone, and welcome you all to ICRA's webinar on Indian construction sector. Mr. Rajeshwar Burla, Group Head, along with Mr. Ashish Modani, Co-Group Head, and Mr. Abhishek Gupta, Sector Head, Corporate Ratings, will take you through the presentation. The presentation will be followed by a Q&A session with the participants. You can place your questions in the Q&A box. Over to you, Rajeshwar.
Thanks, Anju. Good evening, everyone. Welcome to the ICRA webinar on the Indian construction sector. We are joined today by an eminent panelist to share his perspectives on the industry. On behalf of ICRA and the participants, let me welcome Mr. Paramasivan, MD Afcons Infrastructure Limited. Thank you so much, sir. Let me introduce Mr. Paramasivan. Mr. Paramasivan is a whole-time director in the board of Afcons since 2002 and currently its managing director. Overall, he's an experience of over 40 years. He's an alumnus of the University of Madurai, from where he graduated in commerce. He's a certified associate of the Indian Institute of Bankers, a fellow member of the Institute of Cost and Management Accountants of India, and the Institute of Company Secretaries of India. He's also a Stanford certified project manager. He's a member of Taxation and Infrastructure Committee of CII and a member of Infrastructure Committee of FICCI. He also plays an important role in various Indo-African initiatives. It's a pleasure having you with us, Mr. Paramasivan. I am also joined by my colleagues. Yeah, thank you. I'm also joined by my colleagues Ashish Modani, Co-Group Head, and Abhishek Gupta, Sector Head, who closely track this sector. We'll start with a brief presentation, post which we'll invite comments from Mr. Paramasivan, and then open the floor for Q&A from the participants. Participants can type their questions in the Q&A box. Let me now set the context for today's webinar. The construction industry is expected to witness healthy revenue growth in the medium term in the backdrop of strong order book and continued thrust by government on infrastructure activity. While the opportunities remain robust in sectors like transportation, irrigation and drinking water supply, sharp increase in key commodity prices, especially steel, bitumen and cement, along with the heightened competition will have a bearing on the profitability of the players. In today's presentation, we will discuss on these trends, opportunities and key risks, along with findings of our study on resolution of stressed assets in the construction sector. I would now request my colleague Abhishek Gupta to take us through the presentation. Over to you, Abhishek.
Thank you, Rajeshwar, and welcome to all the participants who are in this presentation. We'll start with the presentation. So today's agenda for this webinar, we have divided into 6 broad categories. Initially, we'll discuss about the key macro trends related to the construction sector. This will be followed by key opportunities and challenges that are faced across the sector and faced by the construction entities. Subsequently, we'll look at the performance of a sample of construction entities that we closely track. These are listed entities and a larger set of entities. This will be followed by a study of a resolution plan, a recent study which ICRA had undertaken to study some of the legacy construction entities which had witnessed stress during the last down cycle and are still under NPA classification by the banks. And towards the end of the presentation, we'll look into how the rating in the construction sector by ICRA has moved in the recent past, as well as what is our outlook on the construction sector. To start with the first section on the key macro trends, as has been witnessed in the overall economic activity picking up since the second half of last financial year, that is FY 2021, the construction sector has also witnessed a similar trend. So construction activities have recovered significantly since Q3 of last financial year, and the growth is expected to continue over the medium term. We look at the data point in terms of construction GVA, which is a broader index which covers the overall economic activities in the construction sector. In Q2 of FY 2022, it witnessed a growth of around 7.5%. Again, for the full financial year, because of the lower base which was there in FY 2021, the growth expected for FY 2022 is expected to be in double digits, closer to around 14%. In FY 2023, the growth is again expected to be in double digit, between 12 to 14%. This was expected to be supported by the high impetus given by central government, as well as similar is expected to be followed by state governments on the infrastructure sector. If we look at a slightly higher frequency data points in terms of the raw material, etc., which is used in the construction sector, to get a more broader insights into how the overall activities on ground are taking place. infrastructure and construction goods index, which is a part of the IIP, this has also shown a growth of around 4% in Q3 of FY 2022, and largely is mirroring the trend which is expected for the growth of the overall construction activities. We expect that this index is also likely to grow in double digits between 10 to 12% in this as well as the next financial year, that is FY 2023. Now, if you look at despite of second and third waves, which we have recently seen of COVID-19, the construction sector was relatively lesser impacted in these two waves, particularly in the third wave, compared to the first wave. And there have been multiple factors as have been patent across the sectors. But for construction sector, particularly because the construction activities were allowed during the second and third waves, the impact on the execution was far lesser in these waves. As well as the relaxation measures provided the government, particularly central government, have continued. These liquidity relief measures have also supported the overall construction activities on ground and developers' ability to keep on with the pace of execution despite some of the challenges related to the pandemic. So apart from this, the preparedness of the companies to face post the first wave of pandemic was also better, which has also supported the overall execution on ground. So we've seen that many entities have witnessed, in fact, growth in FY 2021, despite of a significantly weaker Q1. So the catch-up which happened in subsequent quarters in FY 21, particularly from Q3 onwards, was so robust that it was able to cover for the entire loss which was there in Q1, as well as witness a subsequent growth. So with this overall macro trend, let's now look at the overall opportunities that ICRA sees in the construction sector. So construction broadly derives a majority of its order from infrastructure sector. Infrastructure, again, is something which is driven by largely government capex, particularly central and state government, as well as in parts by the private sector capex. If we look at a longer term outlook for the infrastructure investment, as the investment in infrastructure has a higher multiplier effect on the overall economic growth, this has been one of the focus areas for all the governments across the world. And in fact, in India also is one of the key focus areas wherein government has been increasing its allocations and investments. If you look at the data in terms of what has been the pace of infrastructure investment in the past decade, as well as what has been planned under the National Infrastructure Pipeline, the projected investment is expected to double. That is, the annual pace of investment is expected to double over the next 5 years compared to what has been achieved in the last 5 years or so. So at the pace, from a pace of around 10 lakh crore of investment done cumulatively by central, state and private sector, the pace is expected to average at around 20 lakh crores. So over the next 5 years. If we look at which segments are likely to benefit, transportation, which includes roads, railways, as well as airport, metro, etc., are likely to see some major traction and the major allocation. This will be followed by energy or power sector and urban infrastructure. Irrigation, which is partly a state subject, is also likely to see a significant investments in the next 5 years. In terms of the overall financing and the implementing agencies for these projects which are identified under the National Infrastructure Pipeline, state and central are likely to have almost equal share of around 40%, while the balance 20% is to be implemented by the private sector. Financing is largely dependent on allocations from central and state government budgetary allocations, which together are likely to fall somewhere between 42 to 46% of the overall NIP. Apart from this, financing from banks and the new DFI also likely to contribute around 25 to 30%. Balance is likely to be met from bond market equity and asset monetization over the course of this next 5 years or so. If we start looking at the central government, because a major portion of the allocation or the investments on the infrastructure is funded out of budgetary allocation or projects which are identified and developed by central government. So budget does provide a strong guidance on what is the impetus which the government, central government is putting on the infrastructure investment. So if from that perspective, capital outlay on the infrastructure has increased significantly in the recent budget, which was presented for FY 2023, with increase of around 24% over FY 2022 RE to 7.5 lakh crores in FY 23. Railways and roads are likely to see higher allocation up by 14 and 5% respectively. This apart, this budget also had provided around 1 lakh crore as a special assistance to states, which is expected to support the capex by state governments, which had been relatively more impacted because of the pandemic in the last financial year. If we look at the other sources, which would include NIF and the new DFI, I think budget had made allocations towards NIF. However, for DFI, since it has been in the process of setting up and already had allocated around 20,000 crores in the current financial year, no incremental allocation has been made for the next financial year. There were two more announcements in the budget, which would be of importance to the construction sector. These include allowing security bonds in lieu of the bank guarantees, as well as contractor payments cycle being curtailed or cycle being reduced, with government bodies now directed to pay at least 75% of the running bills mandatory within the 10 days time frame. So this does provide some certainty in terms of realization of the bills, which would help the contractors in improving and planning their project execution accordingly. So these are definitely steps in the positive direction. Now, if we look at the state government, again, states have seen increased allocation. Budget have been increasing towards infrastructure investments. However, because of the pandemic, we've seen that FY21 saw, particularly during the first half, a significant decline in the capex by states. Though the second half of the financial year, FY21, there was a significant pickup, which resulted in the overall capex in FY21 being at the similar level as in FY20. So this was significantly lower than the budget because it was not factoring, budget wasn't factoring in the COVID-related disruption. Now, if we look at the current financial year, in the first 9 months, again, the capex has been much better than previous financial year. But if you look at pre-COVID period, still it was around 19% higher if we do a likewise comparison for similar period. So overall, because of this and the focus of some larger states like UP, Karnataka, Tamil Nadu on increasing the budgetary allocations towards infrastructure, we see the overall infrastructure spending by and capex by states to grow at around at least 20% in this financial year, and the trajectory is again similarly expected to be positive only for FY 2023. In terms of the mix where states versus central government capex is allocated, so for state governments, typically transportation, which includes roads, irrigation, water supply, rural development and urban infrastructure, get a majority of the allocation. Whereas for central government, while roads and railways do continue to be having a major share with a total around 40% defense also gets a sizable chunk of allocation to in terms of the central government allocation towards capex, followed by other segments. So these are the broad opportunities that we see for the overall construction sector. Before we move on to the key challenges, we have a short, small poll question. So I'll just read out the poll question for everyone. So the question is that what, according to you, are the reasons for aggressive bidding? That is, the bids which are at substantial discount to the base price by contractors. We have 4 options here. First option is contractors are able to reduce costs with benefits that are available from increased economies of scale, improved efficiencies because of operating in clusters, and hence actually the bids are not aggressive bidding. Second option is because of the relaxation in eligibility criteria and EMT, people are able to bid aggressively. Smaller players are also able to bid for larger contracts and able to this has increased the competitive intensity. Third option is limited opportunities in well-funded state government projects as well as private sector capex, which has resulted in crowding effect in the central government projects. And last option, fourth option, is tendering is not commensurate with the increased capacity of contractors. As a result, for this with the increased capacity, the pie which is there is not commensurate for everyone to be able to get the contracts. So I request everyone to please spare a few seconds to answer. We'll share the results of this poll shortly. Moving on with the presentation. So our next slide is on the competitive intensity only, and that is why we thought to get the opinion of the participants also on how they see the competitive intensity and the reasons for the same. So we have done an analysis of the projects which have been awarded over the last 6 months across sectors, including national highways, railways, metros, irrigation, and water supply and sanitation, these being the key areas where projects have been awarded in this period. We looked at projects with a cutoff of 500 odd crores as a smaller size projects, as well as for certain segments where the contracts in this segment, in this size was not large, we have reduced the cutoff to around 100 odd crores. So on an average, the average number of bidders per contract was significantly higher in the EPC national highway projects that are awarded on EPC basis, with around 15 to 30 bidders on an average across each contract. While, as we understand that for EPC players, we look at about 500 crore of order, the eligible or the contractors which are actually aggressive bidding actively, these would be more than 50 odd players. Compared to other segments wherein the number of players are not that large, as well as for per contract also, the reasons could be that the contract size is larger or eligibility criteria is stricter. The number of bidders per contractor is not that high, and it would range between 5 to 15. This is also the number of bidders would one criteria, but if you look at the difference between the base price as well as the winning bid, the winning bid in case of National Highways Authorities EPC contracts have on an average being 20% lower than the base price. Again, this is median actual. We'll look at the details of the national highway projects in the next sections. But compare this with other segments like metro, etc., where still it is on an average at the positive side, whereas in other segments like railway, etc., it is negative, but not as extreme as in the case of the national highway EPC contracts. Let's now look more into national highway projects, because the number of projects awarded here are larger in terms of number, as well as the bidders are also high. The aggressiveness is also reflected in the chart here in terms of the number of players, as we discussed earlier, the difference between the winning bid as well as the base price, which is identified by the authority. So on an average, while last 2 years, we have seen that both base as well as the maximum discount, median has been in the negative territory, with discount as high as 30% in FY 2021. In FY 22, the discount has widened even further, with maximum discount being close to 45% and an average median discount being as high as 20%. So reasons, as we have discussed in the poll question, in our opinion also the similar includes relaxation just been provided for EMDs, as well as the increased bidding capacity of the players, the favorable execution environment that has been there in the national highway project, which has attracted many players into this sector. And while for NHAI, the mode of award has been both EPC and HAM. HAM projects has seen relatively lesser competition, though that competition is also percolating with 1 year back projects in HAM. The national highways were awarded at a premium of around 20%, but that premium has shrunk in the recent bids, and we've seen that some projects were also awarded at par. So this was the broad risk that we see when these projects would get implemented. The ability of the developers or contractors who have got these projects to profitably maintain or execute these projects is something which remains to be seen. Let's now look at the second. So before we move on to the next question, we have one more poll question here. So this is regarding the rise in the input cost. How do you see that this would impact the contractors' profit margins in FY 2023 versus this financial year, FY 2022? So we'll wait for 30 seconds for everyone to answer. Once again, thank you for providing your opinion. We'll share the results of these polls towards the end of the presentation. Moving on, our next slide and the next list that we identified is regarding the raw material price volatility that we have seen, particularly in the post-pandemic era. So most of the commodities or the raw material which are used in the construction contracts have seen an extraordinary increase in their prices. This price increase which we are showing here is as of December. Post-December also, we've seen in January and February prices have increased, particularly the likes of steel, etc., which has gone up sharply in the recent weeks, which would have widened this increase even further. Now, while to an extent this price increase is passed on to the contractors wherever this is built as a price variation clauses in the contracts, but generally what we have seen is that this is linked to a commodity index as a part of a WPI or CPI otherwise, which may not actually reflect the on-ground price increase on a as efficiently as the price increase that have happened on the ground. So as a result, part of this would have to be borne by the contractors only. And for those contracts where the price variation clause is not available or is linked to a broader index, let's say only WPI, their WPI would not reflect the actual increase in the commodity prices, which has varied sharply. So depending on the nature of the contracts, as well as the extent of composition of these raw materials, there could be a variation in or impact on the contractor's profitability. In our opinion, this could vary between 1 to 4% compared to had this price variation not happened. So let's now move to the next section, which is where we've looked at the performance of a certain set of construction entities, which are listed entities. For our analysis, we have looked at 14 entities, which are listed entities, and they have presence across segments, including infrastructure, building, construction, etc. So order book for most of the construction entities have seen a healthy increase despite pandemic. So in FY21 itself, there was a good increase in the order inflows, and this has continued in the current financial year, is expected to continue in Q4 as well, which would result in the order book increasing in March as per our estimates. And next financial year also, the trend is likely to continue with the pipeline of projects which are there across most of the segments. So while order book to OI ratio would depend upon company across at the aggregate level, the ratio has been between 3 to 3.5 times. In FY21, this ratio has increased to 3.9 times because when we look at the revenue, the base has shrunk while order inflow has remained healthy. As a result, the ratio had increased to 3.9 times. But essentially, any ratio between 3 to 3.5 times for a construction entity which has orders which have execution time frame of 2.5 to 3 years is considered to be a healthy order book position, which would provide them both revenue visibility along with the growth opportunity. So we see this order book position for most of the companies, construction companies, to be comfortable, which would support their overall execution growth over the next medium term. If you look at the performance in terms of revenues and the credit parameters, because of the pandemic, Q1 FY21 had seen a decline for most of the entities, and overall, this has also impacted the overall revenues in FY2021. 22, because of the lower base effect in 21, the growth is expected to be strong, close to around 15 to 17%. And in FY23, again, we expect the growth trajectory to continue with double-digit growth in the revenues. On the profitability side, as we were discussing earlier, because of the pandemic and the commodity prices increase and the high competitive intensity, there has been a dip in the profit margins in FY21 and 22. 9 months 22, again, there has been a decline in the profit margins. We expect that this pressure is likely to continue in FY23 as well, and the profit margins are likely to remain at the levels moderately at the same level as has been in FY22 because of the pressures which is likely to continue. However, with the improved scale, the coverage metrics are likely to improve with interest cover, as well as the leverage metrics are likely to improve as well, with the support coming from the increased scale and overall accruals which have, and the cash flows are expected to improve because of the measures which have been taken by the government. Now, let's look at this towards the end of the presentation about the legacy companies which have faced issues in the past and are comprising a major part of the NPAs of the banks in the construction sector. So we recently did a study about how those resolution plans have been implemented and how are they progressing. But before going to that, let me just share a broad perspective of how the NPAs in the construction sector have moved over the recent couple of years and how they fare with respect to the other sectors. So construction NPA as of September 2021 stood at around 21.1%, while it has come down from close to around 24% in March 2020. So around 1.5 years, it has reduced by around 3%. Part of this is also because of some resolution and some overall increase the base, but still it remains quite high. And the reasons for this, we'll discuss that a few larger entities who have moved to NPAs and the resolution of the same has been a challenge. So for construction sector, I think improving or resolution of these legacy issues would be an important parameter for banks to start increasing the exposure towards the sector without worrying about the risk which have percolated in the past. If we did a study of around 15 odd entities in the construction sector which were under insolvency to assess that how has been the progress and how has been the how is the realization by the lenders, the financial creditors. So broadly, it took around 2 odd years to arrive at a final resolution plan, which of course is slightly longer than what one would ideally expect. And with every passing time, because for construction entities, the risk also is in terms of the non-fund-based facilities or the bank guarantees crystallizing, or with every passing delays in improving the financial profile or resolution plan, the construction entities' ability to efficiently execute or honor their contracts which they have entered into also reduces, which would increase the risk of bank guarantee invocation. So what our study was found that with this delay because of the realization value reducing, and most of the entities, because the construction entities would have largely limited asset base, and it would be mostly continuing business which could result in return of the exposure which banks would have. Realization amount as per the resolution plan was about 2.5 times of the liquidation value for most of these at the aggregate level for these entities. So overall, faster resolution and continuing of the entity as a going concern was what came out as a key takeaway, which would be best interest of everyone to take these entities out of stress. Let's now move to the last section of the presentation, which is on the trends in the credit ratings and how we see ICRA's outlook on the construction sector. We have close to 150 odd entities across, which are largely mid to large size entities, and these ratings are spread across various rating categories, with median rating being at BBB. Last 1 year, the number of upgrades have been higher than the number of downgrades. particularly if we look at the 10-month FY22 data, there have been 17 upgrades versus 11 downgrades. The ratio of upgrade to downgrade is 1.5 times. And the key factors have been with the improved scale of operations, profitability for some of the entities which have been able to demonstrate a healthy increase with lower overheads and support from government in terms of lower BG requirement and improved working capital cycle. The credit profile has increased for these entities, which has resulted in improvement in their credit ratings. Now, going forward, our outlook for construction entities and broadly at construction sector remains stable for FY 2023. So while we expect that operating income for most of the entities would grow close to on an average at around 12 to 15%, profitability could remain under pressure for the reasons that we discussed in the previous slides. Working capital cycle, while the government measures have supported the improvement, if these measures are removed, there could be some elongation, but again, it remains to be seen. So when we compare it with FY22, which had seen a good working capital improvement, there could be some elongation. However, the overall credit metrics are likely to remain similar, or some metrics like interest cover, etc., could see minor reduction, though we do not see that happening at a major level, because of which we maintain our outlook on the sector as stable. This was a broad overview that we wanted to share. Over to you, Rajesh.
Yeah, thanks, Abhishek. So with this backdrop, before I invite comments from Mr. Paramasivan, let us quickly look at the response to our first poll question on discounted bids. Ashish, if you can show the results of the first poll, please. Yeah, so majority of them, almost 54% of the respondents have opined that relaxation in eligibility criteria and EMD are the major reasons for this aggressive bidding or heightened competition. And the next major reason, according to the participants, is limited opportunities in well-funded state projects and private sector capex. So on rising competition and aggressive bidding, Mr. Paramasivan, I'll come to you now. With the relaxation of bidding norms and obviously scaling up of many mid-sized companies, competition has heightened, which is also reflected in some of the slides which we have presented. Now, this is more intense in projects which are funded by central government like national highways and railways. While the competition is good for government to reduce project cost and enhance capacity for project execution, irrational bids could affect the financial health of the contractors, which in turn could actually affect the project execution. So do you see any need for government intervention, and what steps can be adopted to ensure that without any adverse impact, there will not be any adverse impact of this on the overall NIP execution?
Number one, whatever projects the NHA has awarded in the last couple of years, the very fact they have formed a special committee to oversee the progress, which has not happened in the last several years, conveys that the execution phase has come down for some of these contractors, some of these newly won contractors, it has come down. And in terms of the corrections, what is required, I think, which NHA has understood and also moved in the right direction, is that they need to recreate EMD requirement. Once that is done, then some of the non-serious bidders or some of the bidders who are in need of getting the advance for paying their salaries, all these will be out. And then in terms of eligibility criteria also, they should grade the project, say below 500 crores, up to 1,000 crores, above something like that, where the eligibility criteria has to be kept. Below 500 crores, you can permit smaller players as well with EMD. So serious bidders would come down. Serious bidders would only participate. And between 500 to 1,000, you can have some criteria. Above 1,000, you can have some criteria, so that the right people are there. And in terms of technological complexity, also in terms of a project, a routine run-of-the-mill complex and a hill road project, those kind of things can have a difference. Therefore, that is something which definitely the government can do it. In terms of, so that would significantly balance the competition, instead of my saying reduce the competition or other thing. There will be crowding still for below 500 crores project. But that is something which can be managed. Some of them fail also, the government will be in a position to award and get it done. Whereas bigger project, if they fail, time overrun and cost overrun will kill the overall project cost.
That's right.
That could create huge problems to the country on the whole.
Okay.
From that perspective, it is required to be addressed.
Okay. So how do you see the competition and bidding intensity panning out over the next 2 to 3 year period?
Next 2 to 3 years, competitive intensity, we don't expect to come down.
Okay.
See, if you look at it over a period of last 20 years, competitive intensity continues to be on the higher side. If one set of people come, they win the job, they go bust, and then another set of people come. So if you look at some of the well-known names also who are present in the beginning of the current century, many of them are either slowed down significantly or non-existing today. And so similarly, newer crop are coming now thanks to the relaxation in eligibility criteria and waiver of EMD. That set of people, some of them will vanish and others would come. In the process, what happens is the risk perception on the construction or infrastructure companies will be continued to be maintained high by the banking industry, which is what is happening currently. In the process, both good companies and not so great companies or new entrants are equated on the same platform, resulting in even good companies not in a position to get the appropriate banking facilities. That's something which I think we can cover as a part of a later part. But as I just mentioned at this point of time.
Sure. Okay. Thank you. Sir, you raised an interesting point on having a specific criteria depending on the outcome or in terms of quality, what is expected. So recently, Ministry of Finance has allowed procuring entities, especially CPSCs, etc., to use quality cum cost-based selection, QCBS, instead of least cost, which is L1, which is conventionally being adopted. Especially for the contracts where the works are quality oriented. Now, under this regime, the authorities are required to consider assigning not more than 30% weightage to non-financial parameters. What are your views on this QCBS regime, sir?
The QCBS is something which is welcome. Here also, I would say, below a particular value of the contract or not so technologically complex projects, those kind of projects, the government can continue to maintain the L1 norm with some kind of eligibility criteria and EM. But technologically complex project and higher value project, they must compulsorily go for a combination of technology, technical requirements and financial requirements. And here also, the technical requirement, what they have stated, not more than 30% and all, is very, very low.
Yeah.
And in fact, internationally, many places, they adopt a higher level. Many projects we win are not necessarily L1, but based on superior technical credentials. So on the technical side, there are projects where people have kept minimum 50% and 60, 70, up to 70, 80 they have kept for technical, and 20, 30, 40 is what is kept for the financial. So definitely for the challenging projects and high value projects, the government should move in with a technical and commercial requirement, a two-part bid, and they have to arrive at a lowest evaluated bid. There only little caution is required in terms of biases, I would put it. A true technical parameters evaluation has to take place. It should not happen that there things are getting managed. Those should not happen. That's a limited caution. Otherwise, that's a welcome move. And today they have introduced only for consultants, that to up to 30% weightage. The weightage has to significantly go up. And say minimum 50 can go up to 70. And the financial can be about 30%. And there, that is something, especially instead of today restricting it to 10 crores and consultants and all, we should look at high value project, technologically complex projects to move to QCBS.
Sure. So if we shift to QCBS, then one challenge could be how do we handle the bidders who game the scoring system by playing with the various levers? For instance, let's say if 70% weightage is given to the financial bid and abysmally low cost being quoted.
Yes.
Sorry. Yeah. So currently, as things stand today, 70% weightage is given to the financial bid. So an abysmally low cost being quoted such that the sum product of the scores on various parameters could still work in their favor. So how do we weed out such bids?
No, automatically on the technical score, people will move out.
So minimum criteria, minimum scoring is required, is what you're saying.
Okay. L1 basis is not required. For example, we won a job in Maldives, a $500 million project. It is not L1. We are not L1. We were L2. But there they had 60% technical score, 40% commercial score, and on the lowest evaluated bid, we became L1 on the lowest evaluated bid, technical and financial combined. In terms of pure financial, we were not L1.
Okay. So are you suggesting that there should be some minimum criteria scoring also should be looked at for each of these parameters?
100%. Otherwise, it has no value.
Yeah, right. Okay, sure. But one downside to this, Mr. Paramasivan, would be the winning bids under QCBS could be at a substantial premium to authorities' base price, given the huge pipeline of infrastructure projects to be awarded under NIP and Gati Shakti. Can we afford to shift to QCBS at this juncture?
Definitely we can afford. That is where I am saying below a particular value, don't follow that. Say up to 500 crore value, you don't follow QCBS. Beyond 500 crore value, you follow QCBS.
Okay.
And between 500 to 1000, probably you can keep 20% technical, 80% commercial. And below, beyond 1000 crore, you can keep 30, 70. And beyond 2500, you can keep 50-50. Okay. So it will ensure project completion on time. It will ensure right people are bidding on the project. And it will create a win-win situation for everybody. And if you look at this thing, many projects, the project cost gets escalated primarily because of time overrun.
Yeah.
As a result of time overrun, cost overrun. And if that can be overcome, and if that projects can be completed on or ahead of schedule, huge cost saving happens.
Sure.
So therefore, it's a good idea, even if they are required to pay a premium at the beginning.
Okay, sure. So, Mr. Paramasivan, working capital management is another major issue for contractors. Obviously, during the pandemic period, central government has initiated a slew of relief measures like shifting from milestone-based billing to monthly billing, release of retention money, performance security, etc. All these measures have immensely supported the contractors. Their cash conversion cycle has reduced. Now, most of these relief measures are set to expire by March 2022. Do you think the cash conversion cycle will elongate significantly starting April 2022?
With first of all, even this relaxations, whatever was given, it is all for central government projects.
Yes.
Most of the states have not followed that. Number one. Number two, central government projects also, most of the infrastructure construction projects would have some dispute or the other, some variations or the other. Wherever variations, disputes are there, this is not followed. The release of guarantee and others are not followed. Therefore, while it will have an impact, the impact may not be very significant. And also government has conveyed a stated intent that within 10 days, 75% is required to be paid. If that is strictly followed, this will happen. But again, people who are largely exposed to state government projects, they will continue to be in difficulties because state governments, it is not at par with central government in terms of release of money and other things. Many places it takes enormously long time. And especially wherever there is no funding in place for the project, then it's a huge challenge. Therefore, there will be some impact, cash flow release and other things. I am pretty sure this guarantee related requirements, other things, they will continue. Without that, they have to make it as a permanent norm, 3% PPG and all. At one of the forums, one banker was asking, why should I guarantee a performance of a contract, of a contractor, when you have already qualified them technically? When that is the situation, why I should guarantee performance? You should, your qualification itself should be good enough as a performance guarantee. That is what was talked about by one of the bankers. So given that kind of a situation, these kind of relaxations on the guarantee front, other thing should continue, for especially when such huge national infrastructure pipeline is there. And with the thanks to the failures of large number of contractors, the banking sector having been averse to this sector in terms of funding, even good contractors. Therefore, a balanced view may have to be taken by the government in terms of withdrawing this relaxation. So maybe it will be a worthwhile idea for the government to extend this relaxation, considering the huge infrastructure plan the country has.
Okay, sure. So the point which you made that as part of the budget speech, FM talked about mandatory release of 75% of running bills within 10 days. And if you see that in context of the other point which you made, where some of the contractors with various clients, various authorities, there could be disputes in the running bills, monthly bills or milestone-based bills, which they keep raising. So do you foresee any challenges during implementation of this 75% of mandatory release?
Implementation, typically 75%, there is no challenge.
Okay.
There it is, many clients follow even now. There are many metro or other contractors, they say 75% within 7 days, balance in 21 days. That is some system which is already prevalent in many contracts.
Okay.
Therefore, following this is not a challenge at all.
Okay. Sure.
And in any case, only items which are undisputed or where there is no issue of settlement or anything, only those 75% only is paid even currently. They will continue that.
Sure. Okay. So let us now look at the responses to our second poll question on impact of rise in input costs and operating margins of contractors. Ashish, if you could share the results, please. Yeah. So it's a thin majority, I would say. 36% of the respondents have opined that the impact could be up to 100 basis points decline, and almost equal number, 34%, were of the opinion that 100 to 200 basis points could be declined. But almost 70% are of the opinion that there will be impact on the operating margins, which could be in the range of up to 100 basis points in terms of the overall profit margins. So on this point, Mr. Paramasivan, the commodity prices witnessed not only high volatility, but also increased steeply in the last 6 quarters. And obviously, the price variation clauses may not fully mitigate this risk either due to timing mismatches or broader index-based formula, which is used for computations on how to pass on this increase. So how significant is this risk for the construction players? And do you think this is being priced in by the contractors adequately?
No. Contractors never price for abnormal increases. What typically contractors price in for some increase, but not abnormal increase. The way similar thing happened in between 2005 to 2008. And now this cement, as a fact, many of us know that it is a cartelized industry. And irrespective of it, more than our saying, Mr. Gadkari himself has gone on record to state that cement is a cartelized industry. If steel companies claim that it is only input cost increase which has resulted in the price increase, how suddenly all the steel companies have declared huge profits? So that itself should convey very clearly. There also some kind of informal arrangement exists on the steel pricing. It is not necessarily on account of input price increase. We feel that government should play a significant role in terms of formal or informal cartelization of some of these commodities. That's on the one side. On the other side, they have further, some companies have gone on record, another 8,000 rupees per ton increase will happen shortly. That's what they have gone on record. While it's a fact that iron ore prices have gone up for some time, but whole input cost prices have not increased to that extent, deserving so much increase. Over a period of last about 18 months, if we take, 71% is the increase in cost of steel, which is definitely not warranted. And third aspect on this is with respect to while the continued oil price increase could continue to result in increase. Already the oil has crossed $100 back to the olden days, which could consistently impact the diesel cost, which is a significant cost for especially road project or any construction project, and bituminous work. Everything, emulsions, all these prices will go up significantly. And there, it is not the wholesale price index, which is many times followed, or the RB index, whatever is followed, is not compensating the contractor. And abnormal price increase, no contractor prices for. They only price for this thing. Therefore, the best suggestion would be that we move to a star-rated contract, at least in terms of few materials, fuel, steel, cement, some of these. Fuel, when I say add bitumen also in that, All that should move to a star-rated contract. Internationally, FDIC contracts, by and large, follow that. And there have been variations between this thing. Even where some contract terms or FDIC model is followed in India, these are excluded. Therefore, I would say the best solution for this is to move to a star-rated contract for all the major items, grouping which is possible. So if that is done, then the risk of price variation is definitely mitigated to a reasonable extent.
Sure. So just for the benefit of our participants, if you can slightly elaborate on what exactly are these star-rated contracts and what do you mean by fatigue contracts, if you can throw some more light on this.
FDIC is an international contract document. There are multiple variants. Like, for example, the standard variant, what we call is operable, is FDIC Red Book, which is operable for EPC contract, and FDIC Orange Book is operable for item rate contract. Such are these documents, an international organization. They work on this contract from time to time, and standard forms are prescribed in terms of, they call it as FDIC contract document. The FDIC contract document is followed globally in most of the places. And in India, recent times, there has been a tendency to adopt that. However, everywhere there are deviations taken from the FDIC contract document, which is making it more or less as a domestic condition only. And that is as far as the contract condition is concerned. Second, star rated is typically, suppose today is 22nd February, is the date of submission of a bid. 28 days before that, a steel rate is fixed from one agency, let us say, for example. If they change the prices over a period of time, the differential in absolute prices is compensated to the contractor at the absolute value. A formula followed in many international contracts.
Okay. Sure. Thank you.
That's a standard formula followed in many international contracts.
Sure, sir. Okay.
Hello?
So on the, yes, sir. Yeah, you're audible. Can you hear us?
You are able to hear?
Yeah.
Yes, I am able to hear now.
Sure. Okay.
Yes.
Sure. So on the finance,
the contract administration. So the star-rated contract concept. Many contracts in India also.
Mr. Paramasivan, we have lost you in between.
Yes.
Yeah, we can hear you now, sir. Please continue.
No, in many contracts, these star-rated contracts, especially bigger contracts, all those kind of things, it used to be followed. Now, very sparingly, this star-rated concept is used. We have been repeatedly presenting to the government the need for having star-rated contracts.
Sure. Okay. So on the financing and credit availability, sir, for the first time, the budget talked about surety bonds as a substitute for bank guarantees for contractors. Earlier in Jan 2022, IRDA has also come out with certain guidelines on this. This will be very much helpful for mid-sized contractors because typically the margin money and collateral requirement would range anywhere between 45 to 75% of the limits available from the banks overall. So what is your take on surety bonds? In your view, will this be successful in Indian context over the near to medium term?
Globally, surety bond is the most accepted form. In fact, most of our international jobs, we use surety bonds. But in the Indian context, while the FM has taken interest and announced, properly studied IAU, involved IRDA in the presented, what we learn is, so far, no Indian insurance company has presented the product for approval to IRDA.
Yeah.
And from our informal interactions, we learned private insurance companies in India are not very enthusiastic to straight away go for a surety bond. One, on the current risk perception of infrastructure and construction companies. And another, the product itself, they feel it needs maturity to get into the Indian market. That's what they seem to feel. We don't feel so. And the government sector also, so far, they have not this thing, but we do expect at least the second half of 23, some of the public sector insurance companies could move in the product of surety bond. And surety bond is something which the client has to be mentally acceptable to move to surety bond, which how many of them clearly see there is some difference between a surety bond and a bank guarantee. And how many of them will really accept this is a matter of convincing those clienteles into it. And that is one positive aspect which is done by the budget. And another thing which they can think of is today the performance bank guarantee and other go into the project is completed, the asset is put to use. But just because a contractor has gone to an arbitration, these guarantees are not getting released, which I would call it is an extremely unethical act on the part of the employer. The project is put to use, the disputes are there, dispute will anyway be resolved through a process of arbitration, conciliation, whatever. So the guarantees should be mandatorily released on completion of the project as per contract terms. That is something which we need to make it mandatory, which I am sure as some group is working on correcting the anomalies here, this also will get corrected in due course of time.
Okay, sure. So before we take up some other discussion points, sir, we will quickly look at some of the Q&A which got lined up. We will take up a query from Mr. Doshi. He is asking on, given the recent upcycle and even in general, how much upcycle he is referring to the overall increase in the prices of raw materials, the input prices. How much time does it take to reflect the change in price of raw materials in the performance of the companies in terms of reflecting in the EBITDA margins or whatever reported numbers?
And I would put it, the margins could get impacted. Those who have not taken adequate caution, the margins could get impacted straight away. In the current year itself, there could be a reflection. Current in terms of percentage of margin, while absolute because of the increase in the volumes, these absolute numbers could be different. Impact could be straight away for many companies.
So couple of quarters, would that mean couple of quarters, sir? 2 quarters, 1-2 quarters is when it will start reflecting on the numbers?
I feel in the this thing, current financial year itself, it could get reflected, and also going forward, next 4 quarters, we will see the impact of it.
Okay, sure. And a related point again on the same question, how much inventory is generally stored? If you can give an insight on holding period of a couple of major key raw materials.
Typically, raw material holding period is about 4 to 6 weeks. Cement has a shelf life of only 90 days. And therefore, people don't stock more than 2 weeks.
Okay.
And steel, typically people stock for 4 to 6 weeks max. And there is no stocking with respect to fuel and all. It will be probably for 2-3 days max. Wherever they require to have an exclusive license and all to have this stocking.
Okay. Sure. So there is
and
one question.
The other aspects of cost increase, which is not covered as a part of this, and especially that is relevant for international contracts, is logistics cost.
Right.
Has gone through the roof over a period of last about from the time of Suez Canal problems. Consistently, logistics costs have gone up to phenomenal levels, unprecedented. There is no right mitigation mechanism. Wherever people do Indian-funded projects abroad, Indian companies, all of them are hit very badly with no mitigation mechanism currently on. So that is an area of significant thing. Apart from domestic cost increases on account of fuel increase on the logistics, wherever shipping related activities involved on the logistics, huge increase in cost to the tune of 250 to 400%, which is unprecedented. It has never happened in the history. So that is going to be another impact on the profitability. for many companies who operate on international markets and who operate on international markets and not necessarily who is required to send as a part of Indian funding. Certain percentage of Indian content requirement is there, and from India to send it to other places, those who win on international competitive bidding, then and there by, then the issue is much less. But for others who are required to send.
Okay. So would you be able to pass on?
I think I'm lost.
No, we were able to hear you. Just the last couple of words we missed. Just one related point, Mr. Paramasivan. Would you be able to pass on this increase in logistic costs in such cases? Would it be the landed cost is something?
That's what I'm saying. That's what I'm saying. That is what I'm saying. Currently, there is no mitigation mechanism for this.
Okay.
Because it is all fixed to price contract. So contractors have approached Exim Bank and External Affairs Ministry of abnormal increase in logistics cost. They are yet to find any way.
Sure. Okay. So there is one question on your views on GST rate rationalization required for construction sector.
Yes, the rate rationalization is very much required, especially when there is what we call as mismatch in terms of input credit rates and output credit rates. In joint venture entities, it has a problem that there is quite likely of lapsing of GST input credit available. And while the finished product could have 12%, input could be 18%. Therefore, there is need for rationalization of GST rates on some of these areas, which I think organizations have represented individually, collectively, and it is attracting the attention of the powers that be. I am pretty sure it will get corrected in due course of time. There is conscious efforts by the government also to take some of these corrections seriously, and therefore we expect these corrections to happen sooner than later.
Okay. So another question on QCBS. Will more wider adoption of QCBS not result in favoritism or killing of smaller and newer players?
No, that is what I was telling. It is possible. So the removal of bias in that is something which is a major act, which I think the powers that we should play a role in. Definitely, there could be favoritism possibility in the Indian context. So we may have to probably look at initially to implement some kind of an international consultant, not well entrenched in India, but globally exposed. Some big projects we can attempt with them so that they become kind of settle the processes, and then we go to the process better. Otherwise, there is a possibility of favoritism. But when we put different threshold levels for different sizes of contracts, then that is something which below a particular value L1 system can continue, and medium size lesser technical qualification, then higher technical qualification. When the parameters are well defined, I think it can work well. In the longer run, this will be a solution.
Okay, sure. There is one question from Rohit Ahuja. The question is, expectations from government meeting the infra capex committed in the budget, will they overshoot FY 2023 budget estimates or will they underperform?
They will not overshoot. Okay. I would not say they will underperform, but they will not overshoot. But in futuristic, in the national infrastructure pipeline, huge thrust is given on state and private sector. That we need to see how it goes.
Okay.
Because state, in spite of enhanced loan facility offered, that earlier that percentage from 3%, they increased to 3.5%, then they increased to 5%, which is now brought down to 4%. That will all impact in terms of their borrowing ability. And states are more the election focused, and elections keep happening. So in states, we need to see how it goes. But definitely there is a thrust in states also with respect to irrigation and certain kind of connectivity project. Many states are going in, but once they start requiring to fund the operating expenditure of a metro, there will be a rethink. And because except places like Bombay and maybe Delhi, other places, they may find it commercially a requirement to fund operational expenditure because of the population or the many places they are not in Bombay. I would put it even Delhi, they don't pay high metro charge. But Bombay is a place where people are used to paying higher rates, other things. Therefore, here I believe it will be successful. But other places, lower mode of commutation is possible. Like Chennai, for example, if you take a fare of 50 rupees for a metro and a 5 rupees for a bus, people would go in bus. And with a large connectivity available in bus also. So in due course of time, there could be a requirement to fund the operating expenditure of metro as well out of budget. Then there could well be a rethink. Today, everywhere there is a craving for metro. We'll see how it goes.
Sure. What is your view on private sector capex and state government capex? There's another question on that. Now that you touched upon state governments, etc. So both on private sector capex, do you see significant pickup in the activity there?
Most of the state governments, they have the intent. But financing wherewithal is something we need to see. One is borrowing ability, repayment ability, and funding agencies. Many are trying to go international in terms of funding. Many states have to maintain their weighting in fiscal prudence and other things, which typically many states, they don't follow that. All of us are aware. Populism takes precedence over fiscal concern. Therefore, states, huge percentage is kept, nearly 40% is kept for state capex. That is something, maybe if half of which happen, it will be very good, I would put it. In terms of private capex, with the PLI scheme and other thing, definitely something will happen. But we need to see. The private sector investment has not really started to the extent it needs to start. Very small manner it has started. I think it will take time. The settling of this COVID and other things, a lot of people are put into multiple difficulties on account of COVID. So to recover fully and come back, especially MSME sector is all badly affected. It will take definitely more time than what the national infrastructure pipeline anticipates. Therefore, private sector also, they would achieve half or little less than half. So keeping that in mind, infrastructure construction companies should plan their future, I would put it.
Okay, sure. We also see some river linking projects to get started anytime soon, in the next 1-2 years.
Yes, I think Kent Betwa, they have provided in the budget, which actually 3 years before they were to start. And now there is a real kickoff. So first project will commence as the model will develop. River linking is a project where I think it will take a proper shape.
Okay.
Because there, everyone would see the benefit once it starts moving properly. If they are able to satisfy the agricultural portion of the population, I think they have succeeded significantly. The river linking will help that.
Okay, sure. I think a couple of questions are also on state government capex and their overall how they are likely to ramp up. You have already answered that. Just to reiterate, I will just take this up. I think there is a question on 7.5 trillion of capex by the center. How does it compare with respect to NIP allocations, etc.? See, and NIP allocations, if you look at 40% is from center, 40% is from states, and balance 20% is to come from private sector. So that way, if you look at 7.5 trillion, obviously there is a component of defense allocation also in this. If you exclude that, perhaps that would be at about 6 lakh crore, as against if you take 40% of 111 trillion divided by 5 years, there is still a gap of 1.5 to 1.75 trillion, just to answer your question. Yes, sir. So we'll move on to the next question, sir. In terms of HAM projects, with the heightened competition in the EPC space, many of the contractors are also moving to HAM. Of course, HAM is a slightly risky proposition because there is a committed equity there. So do you see that as a challenge? Because if you look at the order book of late in the last 2 quarters, especially, contractors have started picking up these projects simply because EPC contracts are at significant discount to the base price. To get some decent, respectable margins, they had to pick up these contracts.
Correct. That is what is happening. But we know the contractors who have done both construction, EPC construction and HAM together, And the fate of many of those contractors we are aware of in the past. Therefore, while this looks interesting, but it's not a good model. HAM is a separate model by itself. EPC construction is a separate model by itself. Combining both may not be a good idea. One or two projects one can take with reasonably sound financial strength. One or two projects of 1,000 crore value and all, if they take, their capital commitment requirement is comparatively less. But beyond that, if they take, there is a challenge. And many players, once they start taking this route, they'll find it difficult to go back to EPC construction route. Then it will create a challenge in terms of capital constraint. That would pose difficulties for many of those companies.
Yeah.
And which will ultimately result in financial closure issues, all those kind of things. So, but that is something which, as time passes, we need to see. The earlier lot, whoever had combined, we have seen quite a few companies of that.
Yeah.
As to how they have struggled along with it.
Yeah, sure. Just to add on to what Mr. Paramasivan has explained, on this specific trend that we are seeing wherein contractors are shifting towards HAM projects, obviously if the overall equity commitments are substantially higher than the cash generation from the core EPC business, that is going to be a challenge because some of the contractors may end up taking up debt to part fund the equity, which results in double leveraging, etc. It has its own set of issues from the overall credit perspective. Obviously, government has taken note of this. If you look at some of the recent circulars from MORTH and NHAI, on the net worth criteria, the way they're looking at it currently is they're planning to adjust from the net worth whatever equity contributions are likely to happen for the existing HAM portfolio from the developer. And thereby they will arrive at an adjusted net worth to look at the overall qualification for the developer to participate in the process. This is a decent development which has happened. And in case if the financial closure has not been achieved, the entire 15% of the total BPC is something which will get adjusted from the net worth. This is something which the government has taken note of, the shift from EPC to HAM. And given that there could be challenges at a later point of time in terms of financial closure, they have started making these adjustments. So one last point, sir, from my side. Do you think we have made good progress on current dispute resolution or claim settlement process from where we were 5 years ago? What are the bottlenecks still hindering the process?
Not much. If you look at the ease of doing business, while many parameters government has significantly improved, in terms of dispute resolution, by and large where we are. Out of 190 countries, we were somewhere at 186 by 2015. In 2020, we are at 163. If you look at 2017, when Niti Aayog brought in guidelines, 75% of this thing contract based on the guarantee can be released. And it is expected in 12 months, the cases will be disposed of. 2017 cases are even earlier than that. It is yet to be disposed of. And fortunately, that guideline has been changed now. Otherwise, every year one needs to increase the guarantee by 10%. Now that has been removed. That has given some relief. But still, the fact remains there is no timelines. Therefore, contractors many times are forced for a settlement with the authorities even at a loss. From suppose one had 100 crore in an arbitration, it has taken 10 years, not settled. Even at a loss, they are how many years they will have the bank guarantee stuck. And some of them would not have taken the money on the guarantee because of the high requirement from the banking side, even though it is stated as a margin-free guarantee and all. The other parameters are tightened in the process, and today bankers are not willing to give the guarantee itself. So one problem is that. Another problem is with respect to 12 months arbitration. It doesn't happen. It keeps on moving for some reason or the other. It is not even happening in 18 months. So therefore, it continues to have a problem. Third, routinely all the awards are challenged. Irrespective of anything, routinely challenged. And some quasi-government organizations are like metros and all, they take a position that they are not bound by this 75% guidelines. Like some of the metro companies, the metro organizations are doing it writing that they are not bound. And also some of the public sector undertakings also, they are not open to accepting this guarantee and giving. Therefore, on dispute resolution, we are not, and there, in spite of the 2016 arbitration amendment, fairness in the arbitration, other things, still the metro organizations or railway organization, they have their own panel. From their panel to be selected, which are either serving officials or retired officials, which is pathetic, which is not fair at all. So they need to follow the strict arbitration procedure instead of having serving or retired officials their own panel. Many times contractors are forced to go to the court to seek a neutral panel or a panel of judges and all. Therefore, and we should make it mandatory that without an official order and value determination of any variation should not be done by the contractor, should not be asked to do. Similarly, there has to be a time frame for settlement of claims or other things before going to arbitration during the course of the project itself. These are non-existent. Many contracts, they have a dispute review member in the contract provision, but majority of them, they don't appoint a dispute review member at all. Years together, it goes on. So therefore, this is an area of significant improvement for the government. This is an area which puts most of the contractors into huge difficulties. And large monies are stuck. Bankers don't consider it as current asset. Credit rating agency, they don't value it as an asset. It creates a huge problem for the contractors. While really this is cost and payable by the client, as it takes anything between 5 years to 25 years, and it becomes very, very difficult to sustain such kind of disputes.
Even the conciliation mechanism, sir, that has also not yielded much results.
NHA conciliation mechanism has reasonably worked. But other places, there is no proper conciliation mechanism. NHA more, they have a good system of conciliation. At a reasonable, this thing, it works. But other places, there is no proper conciliation mechanism or resolution.
Sure. So thank you so much, sir. Thank you so much for these insights. On behalf of Team ICRA, I would like to thank all the participants for taking out time and joining today's event. I hope you found this useful. I would also like to express gratitude to Mr. Paramasivan for sharing his valuable insights and, as usual, very honest and straightforward in his responses. Thank you so much, sir, again for taking out time out of your busy schedule. Thank you.
Thank you. Thanks for an opportunity. I must really say that it's been a real pleasure. But as usual, I have been very frank in my, as you rightly put it. So it may not be liked by all. Please accept me as what I am. Thank you.
Thank you. Thank you so much.
Thank you.